On interest and discount, 51. Profits made by trading in debts are made in two ways. 1. When the person who buys the debt agrees to defer receiving the profit until the end of the time agreed on. In this case, the profit is termed interest. Thus, when a person buys a debt of £100 payable 1 year hence at £5 per cent interest, he pays the £100 and receives in exchange for it the right to demand £105 at the end of the year. The debt is the price of the money, and the money is the price of the debt. When the debtor pays the debt, he brings £105 in money to his creditor and buys up the right of action against himself to that amount. Both these transactions are sales or exchanges and acts of commerce, and therefore enter into the science of economics. 2. Where the difference or profit is retained at the time of the purchase from the price of the debt, where the difference or profit is retained at the time of the purchase from the price of the debt. In this case, the profit is termed discount. Both discount itself is of two kinds. A, in the ordinary books of algebra, it is said that discount is where the profit is retained at the time of the purchase, and the sum paid for the debt is such a sum as, improved at the given rate of interest, should be equal to the full sum of the debt at the end of the period of advance. It is therefore the present value of the sum agreed upon at the agreed upon rate of profit. This may be called algebraic discount. It is used by insurance companies in determining the present value of future payments, and in some other cases. B. But this kind of discount is never used by bankers and dealers in money. In banking, it is invariably the custom to retain the full amount of the profit agreed upon at the time of purchasing the debt. Thus, if a banker discounts a bill for £100 for a year at 5%, he deducts and retains the full £5 and gives his customer credit for £95. That is, he creates a right of action for £95 to purchase the right to £100 at the end of the year. As this method of discount is the one invariably used in banking and money lending, it is termed banking discount. The rate of interest or discount is the ratio of the profit to the amount of the debt made in some given time as the year. The profits made by interest and algebraic discount are exactly equal, but banking discount is the more profitable because, in the example given, in the former case, a profit of £5 is made on the advance of £100. In the latter case, on the advance of £95. So long as the rate of discount is low, there is not much difference in the profits made by way of interest and banking discount. But as the rate increases, the profit increases at a very rapid ratio, as may be easily seen. If a person lends £100 at 20% interest, he advances £100 and at the end of the year receives £120, which is a profit of 20%. If he discounts a bill for £100 at 20%, he advances only £80 and at the end of the year receives £100, which is a profit of 25%. If he lends £100 at 50% interest, he advances £100 and at the end of the year receives £150, which is a profit of 50%. If he discounts a bill of £100 at 50%, he advances only £50 and at the end of the year receives £100, which is a profit of 100%. So discounting a bill at 50% is a profit of 150%. If a person lends £100 at 100% interest, at the end of the year he receives £200, which is a profit of 100%. If he discounted a bill for £100 At 100%, he would advance nothing, and at the end of the year, he would receive 100 pounds, or his profit would be infinite. It would be out of place to investigate here the whole theory of banking discount, but we have given a full exposition of the subject in our theory and practice of banking and elements of economics. On production. 52. The word production, as a technical term in economics, comes from the Latin producere, which means to lend or bring forth, or to expose for sale. Thus, this, on the Eunuchus of Terence, says, Act 1, Section 2, line 55, hoping for a good price, offers her there for sale, sells her. So, Mendiamus in the Huralon Timormenus says, Act 1, Section 1, line 90, all the slaves, male and female, he offered for sale and sold. So also Suetonius. When anyone's household slaves were offered for sale, the original sense of produce in English is exactly the same. It is draw forth, to cause to come near. Thus in Isaiah 21, it is said, produce your cause, saith the Lord. Bring forth your strong reasons, saith the King of Jacob. And the original note says, produce, cause to come near. So Antony, Julius Caesar, Act 3, Section 1, that's all I seek, and am moreover suitor, that I may produce his body in the marketplace. So Albany says in Lear, Act 5, Section 3, produce their bodies, be they alive or dead. So when Mr. Montague gives Mr. Jonas Schutzlewit and party a dinner, it was as good a one as money or credit, no matter which, could produce. To produce is simply to bring forward something and place it where it is wanted. If a witness is told to produce a deed or document in court, it means that he is to bring it into court and place it there. A party to a cause produces his witnesses in court. A gander is ordered, or a gaoler is ordered to produce the body of his prisoner in court, i.e., to place him there. In the universal language of commerce, the producer is the person who brings anything into the market and offers it for sale. When the turn of the market is for or against the producer, it is for or against the seller. Hence, the true and original meaning of production in economics is to place anything in the market and offer it for sale. A thing may be produced in nature, but until it is offered for sale, it is not produced in economics. A great poet may produce a great poem. A great artist may produce a great picture. A great sculptor may produce a great statue. We may estimate their merits most highly. They may be among the highest products of human genius. But how are we to estimate their market value? For that is the sole way in which they enter into economics. Hence, though the poem, the picture, or the statue may be produced in nature or called into existence, they are not produced in economics until they are brought into the market and offered for sale. So in French, the original and primary meaning of produire, as Littre says, is poser en avant, and of production, it is action, de produire, de mettre en avant. A product in economics is anything, whatever which is brought into the market and offered for sale, whether material, immaterial, or incorporeal. It has been too much the custom in economics to think of the word production as meaning bringing something into existence only. But when it is seen that production means placing something in the market and offering it for sale, it is evident that the product must not only be called into existence, but transported from one place into another. Hence, modern economics expressly class transport or circulation as one form of production. Thus, Destitute de Tracy under production includes changes of form and place. JB, say, enumerates transport under the term production. Michel Chevalier does the same. Mill, who gives the first book of his work to production in the sense of obtaining things from the earth, in a subsequent chapter says, improvements in production, understanding this last expression in its widest sense to include the process of procuring commodities from a distance, as well as that of producing them. Hence, foreign importers, merchants, and traders of all sorts, wholesale and retail, are producers because they transport commodities from one place to another and offer them for sale in the places where they are wanted. Now, money is used to effect all these operations. Hence, money used in any one of them is used as productive capital. But credit is also used exactly in the same way as money to effect all these operations. Hence, credit may be used in all respects like money as productive capital. As far as regards the customer, the tradesman in whose shop he buys it is the producer. What difference can it make whether that tradesman paid wages to workmen in his direct employment and carried the article from his workshop to his counter, or whether he purchases it from an independent manufacturer in a town 300 miles off and transports it from that place to his shop? So far as regards the customer for whom the goods were made, the shopkeeper is the producer. All production is summed up in placing an article in the place where it is wanted. And as transport, commerce, and circulation is indispensable for that object, circulation is one form of production. 3 classes of economic producers. 53. Now, in general, there are 3 distinct kinds of operations necessary before a commodity is placed in the market and offered for sale to the final purchaser, who purchases the finished product and takes it out of commerce for personal use and enjoyment. 1. Agricultural producers. One class of persons obtains the rude produce from the earth. This class includes agriculturalists, miners, hunters, fishermen, breeders of cattle, herds, etc. Bring them into commerce and offer them for sale. 2. Manufacturing producers. But when this raw produce is first brought into the market, it is seldom fitted for final purchase and human use, without undergoing several processes of manufacturing and fashioning. Manufacturers of all sorts purchase the raw produce from its first or agricultural producers and fashion and transform it by an infinity of processes so as to render it fit for human use. 3. Commercial producers. But after the raw produce of the earth has, by the various processes of manufacture, been rendered fit for human use, it has still to be transported from one country to another, and from one place to another in the same country before it is placed in the market, and finally offered for sale to the consumer, who takes it out of commerce for his own use and enjoyment. Now, money is used to effect all these operations. Hence, money employed in any one of them is used as productive capital. But credit is also equally used in exactly the same way as money to effect any of these operations. Hence, credit may be used in all aspects like money as productive capital. On payment and satisfaction. 54. The words payment and satisfaction are often supposed to be synonymous, but they are not so. The word payment means anything, whatever, which is taken in exchange for anything else. It comes originally from the Sanskrit pai, which is the same word as the Greek dori. In Old Latin, this was pago or paco, the same as passiscor, and also pango, pagi, or pansi, panctum, to covenant, agree for, or come to terms with. Thus, it is said in the laws of the 12 tables, if they come to terms, let it be settled as agreed upon. If they do not come to terms, bring on the cause before midday, either in the comitium or the forum. comitium, or the forum. Hence, pasar, is to come to terms with, to appease. Hence the Italian pagare and our pay. When one person has delivered anything to another person or done him a service, he is entitled to receive from him some equivalent, unless it was meant as a donation. But at the same time, he has the right to consider anything he pleases as equivalent. Thus, where two persons agree to exchange any material products, each in payment of the other, because each satisfies and appeases the claim the other has for an equivalent. When goods are paid for in money, it is sometimes supposed it is only the money which is payment for the goods. But the goods are equally payment for the money, because each person has got what he agreed to take in exchange for his product. So when money is paid as wages for work done, the money is payment for the work, but the work is equally payment for the money. So when persons agree to exchange different kinds of work, each is payment for the other. So when a merchant agrees to take a trader's bill at 3 months in exchange for goods, the bill is payment for the goods. It appeases the claim of the merchant because he has agreed to take a right of action in exchange for the goods, and the goods are equally payment for the right of action. When the bill becomes due, the trader has to pay his bill. That is, he has to appease the claim which the owner of the bill has for the money. And when he pays the bill, he buys up the right of action against himself. The money is the payment for the right of action, and the right of action is payment for the money. Hence, to pay means simply to appease. When a man pays a debt, he appeases the right or claim which his creditor has to demand a sum of money from him. When he pays his rent, he appeases the right which the owner of the house, land, etc. has against him for compensation for its use. But it does not follow that a payment is the final closing of the transaction. The only legal word which denotes the final closing of the transaction is satisfaction. If a bill is taken in exchange for goods, it is payment, but it is not satisfaction unless it is expressly received as such, until the bill itself is paid. If, however, the owner of the bill neglects to follow up his legal remedy, the bill becomes not only payment, but satisfaction. By doing so, the owner of it makes it money. And economists go further. They say that money itself is only a higher order of bill, that, though, when a person has received money, it is payment, but it is not satisfaction until he has exchanged away the money for some object he desires. Thus, though a shoemaker is paid when he has got money for his shoes, yet he has not got a satisfaction until he has got bread or meat or clothing or something else he desires in exchange for money. On capital. 55. Adam Smith's use of the word capital strikingly exemplifies the defect of his definitions. He enumerates as capital 1, material things, 2. He enumerates as capital 1, material things, 2, personal qualities, 3, banknotes, bills of exchange, etc., which are abstract rights or credit. Now, when we are told that these things are capital, we have no more idea what capital is than when we are told they are abracadabra. We do not want an enumeration of what things are capital, but we want a definition of what capital is. The word capital is derived from the Latin caput, which means the source of a spring or the root of a plant, namely the source from which any increase flows. Thus, Plantus says, O source or fountain of crimes, O fountain of perjuries. Stephen, in his Thesaurus, thus defines the word caput, unda fractus e reditus manat, capital, the source from which any profit or revenue flows. So Senior says, economists are agreed that whatever gives a profit is properly termed capital, And De Fontaine says, wherever there is a revenue, you perceive capital. This is a good general definition, and the whatever gives a profit must be interpreted in as wide and general a sense as the anything whose value can be measured in money is in the definition of wealth. The definition of capital is therefore this: capital in any economic quantity used for the purpose of profit. Any economic quantity, whatever may be used as capital, any economic quantity, whatever may be used as capital. 56. Now, any economic quantity, whatever, may be used in two different ways. One, the proprietor may use it for his own personal enjoyment. Two, he may trade with it, i.e., he may use it so as to produce a profit. When any economic quantity, whatever, is used so as to produce a profit, it is termed capital. Economic quantities, it has been shown, are of three distinct orders: one, material things; two, personal qualities, both in the form of labor and credit and abstract rights. And each of these quantities may be used in either of the above ways. Material things. Suppose that a person has a sum of money. If he expands it on his own personal gratification or household expenses, such money is not used as capital because he makes no profit by it. But if he lends it out at interest, or if he buys goods with it for the purpose of selling them again at a profit, or if he buys into the funds or the shares of any commercial company, then he uses his money as capital. And the goods are also capital because he intends to sell them at a profit. And the funds and the shares are also his capital because they produce him an annual revenue. So if the owner of land lives on it himself and uses it for his own personal enjoyment, he does not use the land as capital. But if he lets it out to farmers or to builders to build houses upon and receives a rent for so doing, then he uses the land as capital. Some great noblemen possess large tracts of land upon which part of London is built. That land yields them an enormous revenue, and therefore it is capital to them. And so any material thing, whatever may be used as capital. So if a person spends money merely on a general education of which he makes no profitable use, that money is not used as capital. But if he spends his money in acquiring a professional education, such as that of an advocate, or a physician, or a surgeon, or an engineer, or any profession by which he intends to earn an income, then he uses the money as capital. 2. Personal qualities. Personal qualities may also be it sell in both ways. Personal qualities may also be sold in both ways or to sell in both ways. But personal qualities are of two forms. They are of the form A, of labor, and B, of credit. A, personal qualities as labor. If a man digs in his own garden for his amusement, or if he sings, acts, or gives lectures for the delectation of his friends, such labor is not used as capital. But if he sells his labor for any other way, in any other way for money, then he uses his capital, his labor as capital. Then he uses his labor as capital. Thus, Huskisson said he had always maintained that labor is the poor man's capital. So Mr. Cardwell, speaking to his constituents, said, labor is the poor man's capital. So a writer in a daily paper, speaking of the Irish peasants, said, the only capital they possess is their labor, which they must bring into the market to supply their daily wants. And speaking of them, the economist said, they have no capital but their labor. So Fronde says in Oceana, and the land would be within the reach of poor men who have no capital except their labor. So Cardinal Manning says, I claim for labor the rights of capital. It is capital in the truest sense. The capital of money and the capital of strength and skill must be united together. So his knowledge, skill, and abilities are capital to anyone who earns an income as an advocate, physician, singer, engineer, or as manager of a great commercial company, or in any other profession. His services are wanted, demanded by his clients, and paid for, and thus their value is measured in money. Hence, they are some Greek word or wealth, and as he makes an income by them, they are capital. This income is measurable and taxable just in the same way as if he made an income by selling corn, cattle, or any other material chattels. All modern writers admit that labor is a commodity which can be bought and sold like any material chattel, and consequently it is wealth. And as it can be sold for a profit, it may be used as capital. B. Personal qualities as credit. So personal credit may be used in two ways. If a person buys goods for his household use or for personal enjoyment, such credit is not used as capital. But a merchant may use his personal credit for the purpose of profit and therefore as capital. He may use it for the purpose of purchasing goods, materials, or in employing labor by giving a promise to pay at a future time instead of actual money. He sells the goods and makes a profit by so doing, just as if he had paid for them in money. Or he may employ laborers by means of his credit and sell the products for more than they cost, and so make a profit. In this way, he uses his personal credit as capital. When personal qualities, either in the shape of labor or credit, are used in this way to produce a profit, they are termed personal capital. 3. Rights. When personal credit is used as purchasing power, a right of action, or an economic quantity of the third kind is created. And as this right of action may be bought and sold or exchanged like any material chattel, it is termed pecunia, res, bona, merx in Roman law. In Greek law, goods and chattels, etc. Goods and chattels in English law. The traffic in these rights of action is the most colossal branch of modern commerce and is the subject matter of this work, so we shall say nothing more of them here. But any other right may be used as capital. If a man buys the funds or shares in a commercial company or municipal and other obligations, such as railway, debenture stock, all these and many other classes of rights produce him a profit, hence they are capital to him. So the copyright of a successful work is capital to the author, and if he sells it to a publisher, it becomes his fixed capital. There is a class of traders whose business it is to buy and sell rights exclusively. Such are shares in commercial companies and public securities of this nature, and they keep a stock of this kind of property on hand, just as other traders keep a stock of material goods. Capital may increase in two distinct ways. 57. Capital increases in two fundamentally distinct ways. 1, by actual increase of quantity, as cattle, flocks, and herds, and all the fruits of the earth increase by adding to their number or quantity. 2, by commerce or exchange, that is, by exchanging away something which has a lower value in a place and obtaining something in exchange for it of a higher value. Money is used as capital and produces a profit by the second of these methods. Money is used as capital either by advancing a sum of it and acquiring a right to be repaid a larger sum at a future time, or by buying goods which are to be sold for a higher sum than they cost, or by employing labor to produce commodities and selling them at a higher price than the cost of the labor. It is also clear that any economic quantity which is used as a substitute for money and produces exactly the same effects as money may be used as capital as well as money. by the force of the definition, which Senior says all economists are agreed in. Hence, if a merchant or trader can purchase goods or labor with his credit by giving his promise to pay at a future time, and can sell the goods at a higher price than he paid for them in credit, and so make a profit after paying and discharging the debt he incurred in buying them, then it is clear that his credit is capital to him, exactly in the same way and in the same sense that money is. Take a very simple example. Suppose that a trader buys goods for 100 pounds and sells them for 125 pounds. He first replaces his original capital of 100 pounds, and then he has a surplus of 25 pounds. He is therefore better off at 25 pounds at the end of the operation than he was at the beginning, and he has used his money as capital. On the other hand, suppose that the trader saw that he could make a profit if he had the means to purchase goods. But suppose that he has no money and no credit. Then he can purchase no goods, and he can make no profit. But suppose that he has credit, that is, that the owner of the goods has confidence in his skill, integrity, and character. He may sell them the goods and take in exchange for them his promise to pay at a future time. Instead of actual money. Now, as the payment is deferred, and there is always some risk of failure of payment, the price in credit is always higher than the price in money. Suppose that the price in credit is 105 pounds. Then, as before, the trader sells his goods for 125 pounds. At the agreed upon time, he discharges the debt of 105 pounds, and he has a profit of 20 pounds. That is, he is better off by 20 pounds at the end of the operation than he was at the beginning, and thus he has used his credit as capital. Now, by the purchase with money, he is 25 pounds better off at the end of the operation than he was at the beginning, and by the purchase with credit, he is 20 pounds better off than he was at the beginning. It is true that he does not make so great a profit by credit as by money, but yet he has made a profit by his credit, which he could not have made without it. Hence, by the very definition, his credit has been capital to him. But it has produced exactly the same circulation of commodities that money would have done. Hence, it is clear that credit is productive capital exactly in the same way and in the same sense that money is. Thus, we see how a clear and distinct understanding of definitions removes all doubts and difficulties. Many persons have found it very hard to understand how credit is capital, but that entirely depends on the definition of credit and the definition of capital. When it is agreed that anything which has purchasing power is wealth, all difficulty vanishes, because money is purchasing power and also credit is purchasing power. And a trader's purchasing power is his money and his credit. Therefore, his money and his credit are equally wealth to him. And as we have seen that the definition of capital is anything which produces a profit, and that a trader makes a profit equally by his money and his credit, it necessarily follows that he may use his money and his credit equally as capital. Thus, the expression that credit is capital, which has called forth so much dissent in recent times, simply means that commerce is carried on by means of credit, by banknotes and bills of exchange, as well as by money. The meaning of capital as denoting anything by which a profit can be made is constantly used in the common language of politics. Thus, where one party in the state makes an error, the other party is said to make capital of it, i.e., turn it to their own profit. Or when the government achieves a great military or political success, it is said to make capital of it, i.e., turn it to their own profit. So Cobden says in a letter, they have traded for the last 15 years as a political party on the Irish question, but now that capital is exhausted. Hence, capital is anything, whatever which a person trades with and makes a profit by. There is no such thing as absolute capital. 58. It has been shown in a preceding section that there is no such thing as absolute wealth. That is, there is nothing which is in its own nature wealth, and that whether anything is wealth or not depends entirely upon human wants and demand. So also it must be carefully observed that there is no such thing as absolute capital. As Mill observes, the distinction between capital and non-capital does not lie in the kind of commodity, but in the mind of the owner. That is, that whether anything is capital or not in no way depends on the nature of the thing itself, but solely and exclusively on its method of use. Many writers from an imperfect knowledge of the subject may many writers from an imperfect knowledge of the subject say that capital is simply the accumulation of the products of past labor. But this is a vital error which must be carefully guarded against, because all the accumulated products of past labor are not capital, but only that portion of them which is traded with or used for the purposes of profit. Moreover, many things may be used as capital which are in no way the accumulated products of past labor. As Senior says, economists are agreed that whatever gives a profit is properly termed capital. Now, it has been shown that any economic quantity, whatever its nature may be used as capital. Not only may many material commodities be used as capital, which are not the products of past labor, such as land, but personal qualities, both in the form of labor and capital, may be used as capital. And also incorporeal quantities may be used as capital, or for the purposes of profit, as well as any material chattels. In fact, in this great civilized country, the enormously greater amount of capital is purely personal and incorporeal. Some statisticians indeed endeavor to estimate the amount of capital in the country, but it is evident that such attempts are wholly futile, because it is utterly impossible to estimate the amount of economic quantities which are being used as capital at any given instant. And it has been shown that persons trade with and make a profit of not only the realized profits of the past, but also with the expected profits of the future. On fixed and floating or circulating capital, 59, we have seen that there is no such thing as absolute capital, that whether any economic quantity is capital or not depends entirely on its method of use. But capital itself may be used in two different ways. One, the capitalist may retain the object used as capital in his own possession and make a continuous series of profits by its use. And consequently, the capital, supposing it to be worn out, is only replaced with the profits in a series of installments. Capital used in this way is termed fixed capital. 2, the capitalist may part with it entirely and replace the value of the capital and the property in one operation. Hence, it goes away from him entirely and is replaced in one operation. Capital used in this way is termed floating or circulating capital. It must be clearly understood that it is entirely according to the intention of the person who uses it and the purpose and method in which it is used, that it receives either of these names. The same article may be floating capital in the hands of one person and fixed capital in the hands of its next possessor. If the first produces it for the purpose of selling it outright and so replaces the sum expended in producing it in one operation, and the second purchases it for the purpose of making a profit by its continuous use. This distinction is often overlooked, and the term fixed capital is applied to articles of a fixed nature, and the term floating or circulating capital to articles of another nature. Thus, Smith enumerates 4 kinds of fixed capital. 1, the useful machines and instruments of trade which facilitate and abridge labor. 2, buildings used for purposes of profit, both by their proprietor and by those who pay rent for them for trading purposes. 3, improvements in land. 4, the acquired and useful abilities of all the members of the society. This enumeration is imperfect because Smith omits all that stupendious mass of incorporeal property, which has increased to such a gigantic extent in modern times. Thus, if a person invests his money in the funds or in the shares of a commercial company of any sort, or in railway debentures, or in municipal loans, or the obligations of other public bodies, or in purchasing the goodwill of a business, or in a professional practice, or in copyrights or patents, or in any other incorporeal property which yields a revenue. All these are fixed capital to their purchasers. Smith also enumerates 4 kinds of floating or circulating capital, the money by means of which the other 3 are circulated and distributed to their proper consumers. Under the term money, he includes banknotes, bills of exchange, and other securities for money. But all these paper documents are merely rights of action or credit. Hence, Smith expressly includes credit under the term floating or circulating capital. The stock of provisions in the hands of the farmers, citizens, butchers, corn merchants, brewers, etc. 3. The materials in the hands of different work people to be made up, clothes, furniture, etc. 4. The work which is made and completed, but still maintains in the hands of the merchants and manufacturers, but not yet disposed of or distributed to the proper consumers, such as the finished work in the shops of the smith, cabinet maker, goldsmith, jeweler, china merchant, etc. It must be carefully observed that Smith's distinction of certain articles as absolutely fixed capital and of other articles as absolutely circulating capital is to a great extent erroneous. If a person buys land for the purpose of farming it himself for profit, or of letting it out to farmers, or if he buys or builds houses for the purpose of letting them out to tenants, then such lands and houses are fixed capital. But it is quite common for speculators to buy up land and build houses for the express purpose of selling them again, and so recouping their outlay in one operation. In the hands of such speculators, lands and houses so treated are circulating capital. Some manufacturers build engines, which are sold to railway companies, or agricultural implements, which are sold to farmers, or machinery, which is sold to manufacturers. In the hands of the makers, these engines and machinery are floating or circulating capital because they are made for the purpose of being sold outright and so changing hands, and their whole price and profit is recouped in one operation. When they come into the hands of the railway companies, the farmers, and the manufacturers, they become fixed capital because they remain in the possession of their owners, who only recoup themselves gradually for their wear, tear, and deterioration in a series of profits. So a shipbuilder builds ships and sells them to a shipping company. In the hands of the builders, these ships are floating capital. In the hands of the company, they are fixed capital. And so many other instances might be quoted. On the other hand, many articles which are usually used as floating capital may become fixed capital. Furniture, clothes, and plate are usually floating capital because they are usually made for the purpose of being sold. But sometimes they are retained in the hands of their owners and letted out for hire, and then they become fixed capital. If a person purchases the funds or shares or railway debentures for the purpose of investment, and so deriving an income from them, they are fixed capital to him. But there is a class of traders termed stock jobbers who buy this class of property with the intention of selling it again with a profit, and they keep a stock of stocks and shares, as other traders keep a stock of goods. In the hands of these stock jobbers, these securities are floating capital. Another class of traders, named bankers, make a special business of buying debts, i.e. discounting bills of exchange. The bills in the portfolio of a banker are exactly like the goods in the hands of a trader. The trader buys goods from one person at a lower price in order to sell them at a higher price to other persons. And as Smith says, they are floating capital to him. The banker buys bills of exchange, which are merchandise, from one set of persons, his own customers, and sells them at a higher price to other persons, namely the acceptors, and so make a profit. Hence, the bills in the portfolio of a banker are floating capital to him, exactly as the goods in the shop of a trader are floating capital to him. It is therefore incorrect to apply the terms floating or fixed capital absolutely to any articles, whatever their nature may be, unless we know the method in which their owners employ them, and unless an object is incapable of being applied to more than one of these purposes. It is not correct to call it by either name absolutely. There are very few things to which the name of fixed capital may be invariably applied. The only class of economic quantities which are invariably fixed capital are personal qualities. Persons cannot divest themselves absolutely of their qualities. They can only make an income by their use, and therefore they are necessarily fixed capital. On the other hand, money and all articles of consumption, such as corn, wine, oil, coals, meat, etc., are necessarily floating capital because it is not possible to make a profit by them, except by absolutely parting with them. Almost all other property is incapable of being employed in either way at the will of its owner, and therefore is fixed or floating capital. Is therefore fixed or floating capital according to the method it is used. On the three ambiguities in the theory of credit or debt. 60. We have now to notice three perplexities or ambiguities in the theory of credit or debt, which have been the cause of an immense amount of confusion and misconception, which the reader must carefully observe. First ambiguity. A debt is not the money owed by the debtor, but the abstract personal duty to pay the money. We have now to explain the meaning of the word debt, about which there is a great misconception. It is one of the examples of words which, in early jurisprudence and classical Latin, meant a material thing, but has come in the progress of civilization jurisprudence to mean a right and a duty. We think it absolutely certain, in which we are confirmed by the authority of Professor H. Nettleship of Oxford, that in classical Latin the word debitum means the actual material chattel or the money which is due. But in the Pandex, the word debitum is used as synonymous with obligatio or contract, and therefore includes both the creditor's right to demand and the debtor's duty to pay. The idea that the word debt means the money due is very common at the present day and has greatly impeded the due apprehension of the nature of credit. Many literary and mathematical writers suppose that a debt is the money due, or money in the debtor's possession, to which the creditor has a right. This very common error, of which we shall hereafter produce several examples, is expressly provided against in the digest. The essence of obligations does not consist in this, that it makes any specific goods our property, but that it binds some person to pay us something, or to do something, or to guarantee something. Pothier well observes, the right which the obligation gives the creditor of proceeding to obtain payment of the thing, which the debtor is obliged to give him, is not a right in the thing itself. Jus in re. It is only a right against the person of the debtor for the purpose of compelling him to give it. Jus ad rem accruendam. The thing which the debtor is obliged to give continues to belong to him, and the creditor cannot become proprietor of it except by the delivery, real or fictitious, which is made to him by the debtor in the performance of the obligation. And till this delivery is made, the creditor has nothing more than the right of demanding the thing and he has only that right against the person of the debtor who has contracted the obligation. Hence, it follows that if my debtor, after contracting an obligation to give a thing to me, transfers it upon a particular title to a third person, whether by sale or donation, I cannot demand it from the party who has so acquired it, but only from my debtor. The reason is, as the obligation does not, according to our principle, give the creditor any right in the thing which is due to him, I have not any right in the thing which is due to me, that I can pursue against the person in whose hands it may be found. This doctrine is most true. Suppose a creditor comes to his debtor and demands payment of his debt, and the debtor has the very money wherewith to pay his debt in his hand, he may still, nevertheless, give it away or spend it under the very eyes of his creditor. And the creditor has no legal right to prevent him. So, Guide says, a debt is not the material object, the money, but the juridical object, the duty to pay. So Williams says every person who borrows money on mortgage or not incurs a debt or a personal obligation to repay it out of whatever means he possesses. The distinction is perfectly plain and of the greatest importance in economics. If the creditor has the right to any specific money in the debtor's possession, it would be a diminution of the debtor's property. He would have no right to spend or part with it, and there would be only one economic quantity in existence, i.e., the quantity of money. But as a matter of fact, the whole of the money remains the debtor's property, which he can sell or exchange as he pleases. And also there is the property or right in the person of the creditor, which he can sell or exchange as he pleases, and which may be sold or exchanged any number of times till it is paid off and extinguished. Hence, in this case, there are two economic quantities in existence, which may each circulate in commerce at the same time. To consider a debt as a sum of money in the debtor's possession, to which the creditor has a right, is to confound the distinction between a trustee and a debtor. A trustee merely holds money, which is, in reality, the property of the Seska K Trust, and has no right to use it for his own purpose. It forms no part of his property, and therefore it is only one, and not two economic quantities in existence. If the creditor's right were the right to a specific sum of money in the debtor's possession, it would follow that a debtor could never be insolvent. Because if he had no money, his creditor could have no right. But unfortunately, this is far from being the case. In too many cases, persons are insolvent, i.e., they are under the duty to pay money and have no money to pay it with. Not the creditor's right to demand exists whether the debtor has any money to pay it or not. If the creditor's right were the right to a specific sum of money, it would follow that the quantity of credit would never exceed the quantity of money. But this is entirely contrary to fact, because the quantity of credit in existence and in circulation in this country is certainly more than 50 times the quantity of money. Hence, the reader must carefully observe that a debt is simply the abstract personal duty to pay money and has no reference to any specific sum of money. Second ambiguity. The word debt means both the creditor's right of action and the debtor's duty to pay. Number two. The second ambiguity is this. It has been shown that the word debt means the debtor's personal duty to pay money, and not the money which is due. But it has long been used, both in law and common usage, to mean the creditor's right of action as well, and is thus used as synonymous with credit. And the creditor's right of action is termed perfectly, indiscriminately, a credit and a debt. It has been said above that in juridical Latin, the word debitum is used as synonymous with obligatio, and therefore it meant a contract, and therefore includes both the creditor's right of action as well as the debtor's duty to pay. In classical Latin, a creditor's right of action is termed nomen, but in course of time, where obligatio always continued to mean the contract, the word debitum split up into two parts and is now used indiscriminately with credit to mean the creditor's right of action. In the 12th century, the word debitum was commonly used to mean a right of action. In the year 1194, Richard I issued instructions for a judicial visitation on financial matters, in which it was ordered, let all the debts, i.e., rights of action, of the Jews be scheduled, their lands, houses, rents, and possessions. Also, let every Jew swear that he will make a true return of all his debts, rights of action, pledges, rents, and all his property and possessions. In medieval charters, the word debital was used in the same sense. Thus, in one of 1324, it says, in all and singular goods, lordships, baronies, revenues, rents, debts, also known as rights of action, servitudes, homages. In another of 1374, it is said, they have acquired rents, annual revenues, and debts, also known as rights of action, in fee, in which rents, revenues, and debts, also known as rights of action. Thus, the words debitum and debitale were already, at this period, used to mean rights of action in public instruments. And if they were so used in public instruments, it is clear that that must have been their well understood meaning in common usage. And in English law, the word debt has long been used to mean a right of action. Thus, in the Statute of Acton, Burnell, 11 Edward I, year 1283, commonly called the Statute of Merchants, it is said, by which it appears that at that time the word debt had already acquired in English law the meaning of a right of action, a meaning which it has ever since both retained in law and common usage. So it is said in Les Termes de la Ley, first published in 1567, debt is a writ, etc. So Ashe says, quelle det duty chose in action, ou droit. So in the Act 46, Geo, Volume 3, in the year 1806, Chapter 125 or Column 125, Section 3, it is enacted that one debt or demand may be set off against another. So Mr. Williams says, within the class of choses in action was comprised a right of growing importance, namely that of suing for money due, which right is all that is called a debt. We have seen that a debt was anciently considered as a mere right to bring an action against the debtor, when a debt or demand is equitable only, debts being formerly considered as mere rights of action. So, as may be seen in any daily paper, the executors of deceased persons advertise for any persons who have debts, claims, or demands against the estate to give in a statement of them. Orletan says, sous le premier point de vue, le droit personnel se nommés nous créances, which Misters Pritchard and Nasmith translate. Under the first point of view, a personal right is called by us a debt, among the Romans nomen, less usually creditum, in which they are right, because créance in French is the right of action which a creditor has against a debtor, which is, as we have seen, the meaning of debt in English law. It is so perfectly well known that in English law, the word debt means both the creditor's right of action and the debtor's duty to pay, that it is used in both senses in the same act as Parliament. Thus, in the Supreme Court of Judicature Act 36 and 37, the year being 1873, it is said, any absolute assignment in writing under the hand of the assignor of any debt or other legal chosen action where the word debt means the creditor's right of action. But in the same section, paragraph 1, it is said, whose estate may prove to be insufficient for the payment in full of his debts and liabilities, as to debts and liabilities provable, where the word debt means the debtor's duty to pay. An administrator is appointed by the court of the goods, chattels, and credits of the deceased. Thus, it is said that the words credit and debt are used synonymously in law to mean a creditor's right of action. It is exactly the same in common usage. A person makes his will, bequeathing his debts, i.e. rights of action. Accordingly, in the digest of the law of bills of exchange, which we prepared for the Law Digest commissioners, we began with this fundamental definition. Credit or debt in legal and commercial and economical language means a right of action against a person for a sum of money. So in the law of Scotland, debts are included under the title of movable rights. And in a Scottish marriage contract, it is usual for the bride to transfer to her intended husband, all goods, gear, debts, sums of money, and other movable estate. We need not give any more examples. The reader must carefully observe that the word debt is used both in English law and common usage, quite indiscriminately to mean both the creditor's right of action and the debtor's duty to pay, and it requires constant vigilance to perceive in which sense it is used. The word duty also originally meant a right. Thus, the king's duties meant his right to levy customs. This meaning appears in the extract from Ash above cited, but it is seldom used in this sense now. The word right had also this double meaning in English. Thus, Lord Shelburne said in his House of Lords, he would think that America had as good a right to pay taxes as Britain, i.e., it was as much their duty to do so. The word right is not very commonly used in this sense in England at the present day, but it is quite common in Scotland to say, I have no right to do that, i.e., it is not my duty to do it. The word expius in Greek has also this double meaning. It originally meant the actual thing owed, like debitum in Latin, or the duty to pay it. But the Greek jurists use expios to mean the right of action. Thus, Demosthenes says, he left all his property in outstanding debts, i.e. rights of action. In the Basilica, expios is used as synonymous with nomen, créance, a right of action. So in German, the word Schuld properly means a debt or liability. Accordingly, Schuldner properly means a debt. But Austin says that Schuld has also the double meaning, and that in German law, Schuldner is often used to mean a creditor, is often used to mean the creditor. In French, the words droit and debt are also used in the double sense of the right and the duty. And in the creditor's case, it is termed the droit, or debt active. In the debtor's case, it is termed the droit, or debt passive. Thus, Litre says, that is, personal rights, or jura in personam, are distinguished from real rights, or jura in re. Thus, the student must carefully observe that all these words denoting a contract or obligation between two persons, such as expios, debitum, debitale, duty, debt, right, droit, debt, schuld, are used quite indiscriminately with respect to both parties, and it requires constant vigilance to determine in which sense they are used. The explanation of this seeming confusion is this. Expios comes from Ex pi, it is to fit or ordained. Debitum means that which is due, right from rectum, that which is ordered. And if one person has the right to demand and another person has the duty to pay the sum of money, it is equally fit, due, ordained, and right, that the one person should receive as that the other should pay. Hence, they are equally expia, debts, duties, and rights. On the continent, it is usual to term a person's rights simply his actif, and his liability simply his passive. The words droit or debt being understood. Thus, in the accounts of a bank, its liabilities are termed its passif, and its assets its actif.